Most option traders actually don't want to exercise their contract. When you choose to exercise your in-the-money option, you forfeit that extrinsic amount. You literally give it away. Like, take some money out of your wallet, flush it down the toilet, because that's what you're doing when you're exercising the options.
Hey, I'm Desiree.
I'm Denver.
Wait, we should switch.
Okay.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. Now that we've got our foundation in place for options pricing, it's time to revisit the topic of options expiration and discuss exercise and assignment.
This is a big one. Even if you don't plan on holding an option into expiration, you've got to understand the mechanics of how expiration works.
Exactly. All options expire, and if you trade them long enough, you'll eventually run into a scenario where you either have to exercise an option on your own,
Or if you're short an option, you might be assigned on your contract and will be obligated to fulfill the terms of the deal.
So in this video, we're gonna break down the mechanics of exercise and assignment and walk you through what happens if you bought an option and want to exercise it.
Or what happens if you're short an option and you get assigned. Then later on, Kendall and Obi will dive into the details of exercise and assignment. But first, let's revisit the concept of exercise and assignment.
An exercise is when the owner of an option decides to take advantage of the contract's option to buy or sell stock at the strike price. This sets up a process called exercise and assignment. Normally, this isn't the road most traders go down. Rather, most traders generally open options positions with the intent to close them later for a profit, unexercised. But still, roughly around 10% of all options are exercised for various reasons, and when this happens, the seller of the option is obligated to act. If the buyer of a call option exercises their right to buy stock, the seller is obligated to deliver shares. If the buyer of a put option exercises their right to sell shares, the seller is obligated to buy shares. When an option is exercised, it's reported to the OCC. They'll match up the respective purchase and sale of stock, and then you'll see your brokerage account position adjust accordingly. Let's take a closer look at what this is like. Obi, give us the deets.
All right, let's take a look at an example of exercising a call option. All right, for this example, we have the XYZ 150 strike call option. The buyer on the left here, remember they're the holder of the option. They have rights. It is their decision whether or not to exercise the option prior to expiration. And because it's a call option, they have rights to buy stock at the strike price of 150. Meanwhile, the seller or writer of the option, they have obligations. They are in the passenger seat. If the buyer of the option chooses to exercise the option, the seller is then assigned and they're obligated, in the case of a call option, to sell shares of stock. So what does the buyer have to do? Well, because they're paying for shares, they've got to cough up money. In this case, 150 is the strike price that they will pay. And because each options contract controls 100 shares, it would be 150 times 100. That means they need to bring $15,000 to the table. Now, that money is going to go to the seller of the option in exchange for 100 shares of XYZ. So money goes from buyer to seller. The seller delivers the shares of stock. As a result, the buyer of the call option who just exercised the option, they now own 100 shares of XYZ. This is a long stock position. Now, what about the seller of the option? They've been assigned, they've delivered shares. Well, one of two scenarios could take place. Let's imagine before the assignment, the seller of the option already owned 100 shares of XYZ, and now they've been assigned at the strike price of 150. They have now sold 100 shares. And so for keeping track, they now have 0 shares, which remember, we call this a flat position. But what if they didn't have the shares? Well, if they started out with 0 XYZ, and are assigned on the option, they're obligated to sell shares whether they own them or not. And if they don't own them, well, now they are short 100 shares of XYZ. This is a short stock position, and this raises our danger flags. Remember, short stock is unlimited risk to the upside. So if you sell a call and you do not own those underlying shares ahead of time, well, if you get assigned, you're going to be left with a short stock position and unlimited risk to the upside. All right, let's take a look at an example of a put option that has been exercised. Here we have the XYZ 150 put. The buyer of the put has rights, just like the buyer of a call, but in this case, they have rights to sell XYZ at 150. Meanwhile, the seller or writer of the put option, they are of course obligated to fulfill that. And in this case, they're obligated to buy stock at 150. The buyer in this case, because they're selling shares, they are delivering 100 shares of XYZ at $150 per share. Those shares go over to the seller of the put who is buying shares. Meanwhile, the seller of the put has to come up with the money to pay for the shares. In this case, $15,000. Remember, 150 times the 100 contract multiplier, that's $15,000 in cash that the seller of the put is sending over to the buyer of the put because they've sold shares. Now, what happens to the buyer of the put? Well, it depends. If they already owned XYZ, well, now they're selling 100 shares of the stock at the strike price, and their position is now flat. They have no more shares. But what if they didn't own shares and they exercised the right to sell stock? Well, if they started with 0 shares and they sell 100 shares, they are now short 100 shares of XYZ, and this again is a short stock position. Danger, danger, unlimited risk to the upside. Now, what about the seller of the put? Well, they have now taken ownership of 100 shares of XYZ at $150 per share, and they now have a long stock position. And those are the mechanics of exercise and assignment for both a call and a put.
When it comes to exercise and assignment, there are 2 styles of options, European and American style. But don't worry, you won't need your passport, and they have nothing to do with where the options are traded. In fact, both styles are traded on US exchanges, with the only difference being when the options may be exercised and assigned. American-style options can be exercised at any time on or before expiration, which means that the seller may be assigned early. Meanwhile, European-style options can only be exercised at expiration, so there's no risk of early assignment. Generally speaking, stock and ETF options are American-style contracts, while more sophisticated products like stock index options are European-style. And don't forget, either style of option can still be closed at any point during the contract's lifetime.
In this episode, you've heard about exercising options. Now, it doesn't happen all the time, but when it does, you need to know what happens.
Let's say I'm a hypothetical options trader, and it's the week of expiration. I have risk in mind. What should be going through my mind at this point?
So let's break it down to the basics, just as a reminder. So when you own an options contract, you have the right to exercise that contract. Whereas on the other hand, if you're the seller, you have the obligation to fulfill the terms of that contract. So as the seller, if you get assigned, that's what it's called, you have no control over when that assignment occurs. You can't request that an assignment occurs or request that an assignment doesn't occur. Let's dive in a little bit to the expiration portion of this. So Let's say that you decide to hold the contract up until expiration. And now there's risk on both sides of this scenario. For the buyer and the seller, there's risk. So you were asking, going into expiration week, what should I be looking out for? Well, you want to be actively monitoring your positions, potentially trying to close out the positions if you don't want a scenario to occur. That's the best way to take control of the situation, regardless what side you're on, is to manage that risk yourself, attempt to, and try to close out the position in the market prior to expiration.
Now, as the buyer of an option, we can always try to sell that option before expiration. Now, in best case scenario, the value of that premium has gone up since we bought it, and therefore we can attempt to sell it at a profit. So for example, if I bought an option for $2, it's trading for $5 before expiration, we can try to sell it at the current market price and pocket that difference. That's the ideal scenario for most options traders. Most option traders actually don't want to exercise their contract. So that's something to keep in mind. Now, for the seller of an option, our goal is that that option goes out worthless, so we keep the premium. And sort of to Denver's question, if you want to avoid any sort of weird things happening on Friday going into expiration, maybe it's Friday afternoon, you're checking your app, oh, this option is worthless, I think I'll be fine. Well, stocks can move late in the day and in after hours. So if I wanted to take that assignment risk off the table, I could try to buy back that option, and maybe it's trading for a small amount. Maybe I sold the option for $2 and now it's trading for 10 cents late in the day. Sure, I'm not gonna keep my full $2 premium, but at that point you gotta ask yourself, is it worth trying to squeeze out that extra 10 cents in premium for what could be potential assignment risk if the stock moves? So those are things to keep in mind. And then always remember, when you're trading options, the liquidity in the market is going to determine whether or not you can get in and out of a position late in the day on expiration. So keep that in mind.
Absolutely, yeah.
So what happens if I wait till expiration?
Let's analyze the buyer for a second, because you'd think, well, I'm the buyer of this contract. I can decide if I want to exercise or not, and I'm just going to ride it out. Now there's risk there, and you'd think, how is there risk there? I'm in the driver's seat, right? The OCC, which we've mentioned a little bit here, the Options Clearing Corporation, is kind of the middleman between buyers and sellers of contracts. Now they have a process that some new investors might not know about. And what happens is if you hold an options contract, you own an option contract. If that contract ends the trading day 1 penny or more in the money, 1 cent, they will automatically exercise that position on your behalf. Depending on the balance within your brokerage account, it could dip you into a margin call. It can open you up to kind of a nasty situation.
Well, think about it this way, right? You own a call that you thought was maybe gonna go out worthless, and so you kind of stop paying attention. It ends up a penny in the money, and now you exercise and buy 100 shares of that stock. Let's go back to episode 2 when we broke down long stock, short stock, right? What's your risk of owning 100 shares of stock? That the price goes down, right? So that's risk, right? Flip it on its head. If you are long a put contract and you are now selling 100 shares of stock that maybe you don't own, remember the risk of a short stock position is unlimited risk to the upside.
Yikes.
That's right.
So this is why it's so important to, one, understand long stock, short stock. So go back to episode 2, watch that episode. But generally speaking, Denver, to your question, manage your risk in the expiration, and it helps alleviate some of the concerns that happen after the closing bell on Friday.
And it's kind of different. This expiration risk is, the processes in place are a little bit different at every brokerage firm, because we have processes in place to help try to eliminate that expiration risk that you may be exposed to. And there's the potential, let's say maybe you don't have the buying power available in your account to purchase those shares.
So if you buy a put that is deep in the money, and you're like, oh, I'm just gonna take on these short shares, well, we don't allow that at Robinhood at this point. So as a trader, the best thing you can do is manage your position, manage your risk. The last thing you want to do as an options trader is take a vacation on expiration and not look at your positions. You should be looking at that every day of the week leading up to expiration, and ideally try to close these positions or roll them out to further expirations sometime during that week of expiration. But once again, that's not a guarantee as well, because If you have a short option that's in the money and is getting deeper in the money, the likelihood of an early assignment grows every single day as you get close to expiration.
I'm really trying to sink my teeth in. Are there scenarios where you just go in wanting to exercise your option?
We mentioned in episode 2, some stocks pay a dividend, right? If you own shares of stock, you have rights to those dividends. If you own a call option, you do not get that dividend.
That's right.
So some call option owners, depending on where the stock is trading versus the strike price, may choose to exercise that option before expiration so that they can become a shareholder in time to receive the dividend.
I see.
And this is something we call dividend risk. So if you're the seller of that call option, you got to worry about an early assignment because then you're going to have a short share position and have to pay that dividend. We're going to cover this a lot later. I don't want to overwhelm you. But yes, there are reasons for someone to exercise an option early,
Okay.
potentially to capture a dividend.
Is there a scenario where exercising could be better than just giving or closing the option?
Well, this gets into sort of the strategy of how to potentially profit from your option, right? Most new traders, because once again, if you think about all the stuff we've talked about in these early episodes, we've talked a lot about rights, obligation, strike price in the money, exercising. And so we think if this was an options textbook and we're in the first few chapters, we think, oh, this is how options work. I want to buy an option, I want it to get in the money, and I want to exercise it to take my profit. Right? Not necessarily true. What I mean by that, if you guys remember when we looked at the premium of an option, we looked at in the money options that had intrinsic value and extrinsic value.
Yeah.
When you choose to exercise your in-the-money option, you forfeit that extrinsic amount. You literally give it away. Like, take some money out of your wallet, flush it down the toilet, because that's what you're doing when you're exercising the option. So if your intention is to buy an option in order to profit from it, the ideal scenario would be to sell to close the option because you capture that extrinsic value when you sell that premium.
Got it.
When you exercise it, you get the intrinsic in the resulting stock position, and that extrinsic money goes away. So if you're watching out there, if you have questions about whether it makes sense to exercise your option or not, reach out to our options team. Kendall and the team here are ready and waiting to help and answer your questions. Because trust me, I've seen too many new options traders literally forfeit and give away money that is built into the option.
Wow, there's a lot of risk to be aware of. There was dividend risk, expiration risk,
Assignment risk.
Yeah.
Well, I feel like I'm more prepared. How about you, Denver?
I'm getting there.
I know we can't go too close to expiration date, or you can, but it is wise to mitigate that risk. Caution as expiration date approaches.
I'd love to point out as well, like we briefly touched on it, every brokerage firm does have procedures in place to try to help mitigate this risk that investors are exposed to when they hold options through till expiration. Really, really try to understand those procedures as an investor. You need to know what your brokerage firm's policies are and what actions they may take in your account, because it can be very alarming to have action taken and you not be aware of it. If you have any questions, reach out to them and ask, because you really don't want to be surprised when you're an hour before close on expiration and something is happening in your account. Or, you know,
I'm not gonna wait that long.
They don't do anything and then you're exposed to risk and you don't do anything. And
talk to your broker. Ask your broker, how does it work here? Read your customer agreement. Don't rely on sort of third-party advice or information. Talk to your broker.
Definitely.
I think we're gonna do all those things after this.
Immediately. Well, I mean, you guys completely answered my question from a risk perspective. Like, you've really hammered home the idea that when my option is expired, I have to be proactive. Like, that is my biggest takeaway. No matter what I do, I have to figure out a plan of action. I can't rely on whatever the mechanisms are, when it comes time to expiration. So no, that is just resonated in my mind.
Yeah, that's a
love
great
it.
point, Denver. I feel like I don't want to be surprised either. I want to, keep track of everything that I have and know what's coming.
Yeah.
Thanks for watching the video. If you enjoyed this episode, smash that like button, leave a comment, and don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risks and are not suitable for all investors. Before trading, check out the link below in the description.